Hello everyone, I hope you are doing fine, and in this video we will be discussing about the components of the cash flow statements and the fund flow statement. So let us just first talk about the components of the cash flow statement. It is firstly the operating activities. These include the principal revenue producing activities of the enterprise and the other activities that are not investing or financing activities. So first, let us just talk about what is an operating activity. An operating activity is something which is a part of your day-to-day business. Let me just design a canvas in order to make you understand. Operating activities. For example, factory expenses. For example, inventory management. For example, revenue, electricity, bill, truck, remuneration, toll tax for inventories. Basically, in general terms, all the transactions which are a part of the trading account are considered as my operating activities. Operations here means the day-to-day operations of a business entity. Okay, then comes the investing activities. What does investing activity mean? These include the acquisition of the disposal of the long-term assets after the investments are not included in the cash flow. Cash flows from these investing activities represent the extent to which the expenditures have been made for the resources intended to generate the future income and the cash outflows. Investing activities, sale of assets, purchase of assets, investments for expansion, capital budgeting, decisions, nominal value calculations, future value calculations. These are all the part of my financing activities. Sorry, investing activities. In general terms, all the transactions which are a part of the balance sheet or are considered as the expenses and revenue for the future prospects are known as the investing activity. And last comes the financing activities. When we talk about the financing activities, these are the activities that result in the changes in the size and the composition of the equity share capital and the borrowings of an enterprise. Cash flow from the financing activities are useful in predicting the claims on the future cash flows by providing by the providers of the capital to the enterprise. For example, issuance of share capital, redemption of debentures, distribution of dividends, bank loans, debate. These all are a part of the financial activity. So, in general terms, all the transactions which are a part of the capital accumulation and borrowings of an enterprise are considered as a part of the financing activities. Okay. Now, in order to prepare a cash flow statement, we need these three things. That is the operating activities, investing activities, and the financing. After that, we have the two methods. Methods to prepare a cash flow statement. First of all is the direct method. Now in the direct method, major classes of the gross receipts and payments. So it reports the major classes of gross cash receipts and payments. It also provides more useful information compared to the indirect. But it is commonly used. Most it is less commonly used. We follow the indirect method more. Now let us just learn what is indirect method. The indirect method starts with the net income and adjusts for changes in balance sheet, accounts to reconcile net income to net cash provided by the operating activities. Let us just read it again. The indirect method starts with the net income and adjusts for the changes in the balance sheet. So it accounts for the changes in the balance sheet. That means we will have to make a comparative balance sheet and then reconcile the net income to the net cash provided by the activities of the operating nature. Okay. So let us just examine how the cash flow statements from operating activities look like. Blueprint of okay. So first of all is the net income. Net income starts with the net income figure from the income statement. Then we look for adjustments for non-cash items. Non-cash item सबसे बड़ा क्या हुआ depreciation. So we'll add back the depreciation, amortization, or other non-cash expenses. So basically all the non-cash expenses are added back. Then we adjust for gains and losses on sales of assets. Okay. And after that, we look forward for changes in the working capital. Adjust the, or I should say, adjust for changes in current assets, excluding the cash and current liabilities. Okay. So this is how the format looks like. We have the net income, then we look for the adjustments. After the adjustments, if there is a gain minus loss at all, as it is, then changes, increase or decrease, that is how it is calculated. Now let us talk about cash flow from investing. Cash flow from the investment activities. So number one thing is cash inflows. Proceeds from sale of property, plant and equipment. After that, proceeds from sale of investments. Other than that, cash outflows, purchase of property, plant and equipment, and purchase of investment. This is out of blueprint, or you should say the format of investing activities looks like. Then lastly, financing. In the financing activities, we look forward for cash inflows from proceeds from issuing shares, proceeds from issuing debt, and we look for cash outflows from repayment of debt and dividends paid. And this is how the format of a investing activity should look. Next up, we look forward for net increase and if decrease in the positive sense, sorry, in the negative sense, decrease in cash and cash equivalents. So for that, we will summarize the net cash provided by or used in operating, investing, and financing activities to get the net change, the cash and the cash equivalents. Okay, and this is how format will look like. After that, let us just take an example of the direct method. Let us just say we have a question. Aman Limited have the following transactions. Prepare a cash flow statement in the direct method. Okay, so let us just dive in and let us just say cash receipts from customers will be it will be rupees 100. Cash receipts from other operating activities it will be rupees let us suppose say 50,000. Cash payment to suppliers rupees 20,000. Cash payment to employees that will be rupees 28 oh, sorry 50,000. Cash payments for other activities that will be rupees 15. Now let us just prepare a simulation. For the sake of the solution, we will draft the format. Receipts, that is the cash receipts from customers. It is rupees 1 lakh. Cash receipts from other income. Total receipts will be rupees 1,50,000. After that, we'll talk about the payments, which is as follows. It will always be in the negative part since it is the payment, not it is an expense. It is an expense for us. So that my total payments will account for my total payments will account for 50 plus 20, 70, and then it is 85,000. Okay. The net cash provided by operating activities will be equal to 1,50,000 minus 55,000, which will be equal to 1,50,000 minus 85, 65,000. So this is how the solution will look like. Okay. First, we'll talk about the receipts. Then we'll talk about the payments. Okay. And the net cash flow will be like this. Now, let us make some important notes. Let us have some important notes. That is the non-cash transactions. What will happen to the non-cash? If there are non-cash transactions, not included in the cash, not included in the cash flow, and are added back. if it is an expense and subtracted if it is an income. Okay, but disclosed to the footnotes in accounts. Okay, and if we are talking about interest and dividends, it is classified in financing activities if you are paying it. But if you are receiving it, it can be considered part of your operating. Okay. Now, let us just have a quick view regarding the sample cash flow statement using the indirect method. Now, it is using the indirect method. So here, first of all, let us understand the cash flow from operating activities. It will be this. After that, the cash flow from investing activities. Then finally, the cash flow from financing activities. And net increase cash and cash equivalents. Okay. Now let us just understand it, what has happened. We have just made the question, but we haven't understood it. So what we did using the indirect method. First of all, we assume that we have a net income. We assume that we have a net income of rupees 5 lakhs, out of which the depreciation is rupees 1 lakh and the amortization is rupees 50,000. Gain and loss in the sale of asset rupees 10,000. So we worked in by changing the working capital from the balance sheet. We have 20,000, 30,000, 40,000, and so the net cash provided by the operating activity is 6 lakh 30. After that, we followed the cash flow from the investing activities. We have the proceeds from the sale of the equipment that is 1,50,000. Proceeds from the sale of investment that is rupees 50,000. Purchase of the equipment that is rupees 2 lakhs. Purchase of the investment again, sorry, purchase of the equipment rupees 2 lakh. Purchase of the investment rupees 80,000. And then the net cash used in the investment. Now, since it is a purchase, that means it is showing the negative point. Now, from the financing activities. Now, it is from the cash flow from the financing activities. Proceeds from the issuing shares, 3 lakhs. Proceeds from issuing debt is rupees 2 lakhs. Repayment of debt is rupees 2 lakh 50,000. Dividends paid is rupees 50,000. So the net cash flow provided by the activities would be this one. Now, we shall talk about the net increase in the cash and cash equivalent. Okay. Net increase in the cash and cash equivalent is rupees 7 lakh 50,000. Now, 6 lakh 30,000 plus 2 lakh. 6 lakh 30,000 plus 2 lakh minus 30,000. That is 7 lakh 50,000. At the beginning of the period was rupees 1 lakh, and at the end of the period it is rupees 8 lakh 50,000. Okay. So I hope you have understood this question and how the cash flow from the direct method and the indirect method works. Thank you.